The following adjustments is typically made when valuing a closely held private company. Discount for lack of marketability, yes. Premium for highly public shareholdings, no. Reduction in value for brand recognition, no. No adjustment are required. So the answer is A. As per ICA Valuation Standard 202, valuation documentation must include only financial statements, only management representation letter, records of valuation procedures, evidence obtained, and conclusion reached, publicly available market reports. So the answer is C. The minimum, the minimum retention period for valuation documentation as per ICA valuation standard is 3 year, 5 year, 8 year, 10 years. So the answer is C, 8 years. Which of the following is not a key benefits of valuation documentation? Which is not a key benefits? A, transparency it is. B, consistency it is. Legal defensibility it is. D, price manipulation. So the answer is D. It is not a key benefit. The management representation letter primarily serves to confirm certain facts or matter relevant to the valuation. Yes. Replace financial statement in the valuation process. No. Determine the valuation method to be used. Justify an arbitrary valuation result. So the answer is A. Confirm certain facts, matters relevant to the valuation. A valuation report must include which of the following? The valuer's assumption, yes, and method, yes. A fixed price for the assets being valued, no. A speculative financial projection only, no. A disclaimer that valuation findings are not subject to scrutiny, no. So the answer is A. The valuation process typically begins with signing an engagement letter and defining the scope of the work, yes. Preparing financial projection without consulting management, no. Directly applying valuation formulas, selecting a random valuation approach, no. So the answer is A. Under the company's rule 2017, the responsibility of maintaining valuation documentation lies with the auditor of the company, the CFO, the valuer conducting the valuation, the regulatory authority. So the answer is C, the valuer conducting the valuation. In the context of valuation, substance over form means focusing on the economic reality of a transaction rather than its legal structure, yes. Giving priority to legal documentation over valuation analysis, no. Using a formulaic approach without considering external factors, ignoring intangible assets in valuation. So focusing on economic reality of a transaction rather than its legal structure. So the answer is A. Which of the following is not a type of valuation report? Summary report, a detailed report, qualitative report, compliance report. So which is not a type? So the answer is C, qualitative. The management representation letter typically required when the valuation assignment involves material assumption and management provided data. The valuer is conducting a market-based valuation only. The company has no financial statement available. The valuation is conducted for a regulatory compliance purpose only. So the management representation letter is typically required when the valuation assignment involves material assumption and management provided data. So the answer is A. Which regulatory provision mandates valuation under the IBC 2016? Regulation 27, yes. Appointment of registered valuers. Regulation 56, RPT, no. Regulation 15, taxation requirements for insolvent entity, market price determination. So the answer is A. As per ICA valuation standard, valuation reports must include identity identity of the valuer, and any conflict of interest. Yes, only numerical calculation without qualitative analysis. No assumption, but not the valuation methods. No predetermined outcomes agreed upon the management. No. So the answer is A. Which of the following valuation approach is most appropriate for distressed company under liquidation? Discounted cash flow methods, market approach, liquidation value method, P ratio. So the answer is C, liquidation value method. The key objectives of valuation report is key objectives of report valuation report. Assist stakeholder in decision making, yes, by providing a fair valuation. Justify an increase in share price, replace statutory financial reporting requirements, provide subjective opinion without factual support. So the answer is A. Which of the following is not a component of a valuation report? Source of information relied upon. No. Key valuation method used. No. The valuer's personal investment history. Disclosure of major assumption made. So what is not a component? So the answer is C. Source of information, it is a component. Key valuation method, it is a component. Disclosure of major assumption, it is a component. So the which is not a component, so the answer is C. Primary purpose of valuation standard is ensure consistency, yes. Transparency, yes. Credibility in valuation, yes. Maximize the reported financial position of a company, provide tax benefit to business, reduce regulatory requirements for companies. So the answer is A. Which of the following valuation approach relied primarily on analyzing recent market transaction of similar assets? Analyzing recent market transaction of similar assets. Income approach, no. Market approach, yes. Cost approach, liquidation approach. So the answer is B, market approach. As per valuation standard, which factor is not considered while selecting a valuation approach? Availability of sufficient and reliable data, legal and regulatory requirement, the personal preference of the valuer, the nature and characteristic of the assets being held, which is not considered while selecting a valuation approach. So the answer is C. NAV, net asset value method is most appropriate. Startups with negative earnings, companies with significant tangible assets, businesses with strong brand value, high growth technology firms. Net asset value. So the answer should be B, companies with significant tangible assets. Which of the following is not recognized under method income approach? Discounted cash flow methods, capitalization of earning, price earning ratio, multi-stage growth. So which is not under income approach? So the answer should be price earning, because discounted cash flow is income approach, capitalization of earnings is income approach, multi-stage growth is income approach. What is the primary limitation of using discounted cash flow method for valuation? It does not consider market condition. It is highly dependent on future projection, yes, and assumption. It is applicable only to the assets heavy businesses. It cannot be used for business valuation. So the answer is B. Which valuation method is commonly used in merger and acquisition to determine fair exchange ratio? Liquidation value methods, relative valuation approach, book value methods, historical cost approach. Which is commonly used in merger and acquisitions? It should be B, relative valuation approach. As per ICA valuation standard, which of the following factor is the least relevant while determining fair value? Synergies available to a specific buyer, prevailing market condition, expected future earnings of the assets, comparable transaction in the industry. Which factor is the least relevant? So the answer should be A. The term highest and best use refers to the price that an asset can fetch in a distressed sale. No, the use of an asset that maximize its value in the market. Current use of the assets as recorded in the book. Tax implications. So the answer should be B. The control premium in valuation is typically applied when the buyer requires a significant influence over the company. The buyer has high level of debts. The business is undergoing liquidation. No. The primary operates in a declining industry. No. The company has a high level of debts. No. Control premium. The buyers acquires a significant influence over the company. So the answer should be A. Which of the following is not a common adjustment made in valuation? Discount for lack of marketability, control premium, synergy adjustment, bonus issue adjustment, which is not a common adjustment. So the answer should be D, bonus issue. The WACC, weighted average cost of capital, is used in valuation to determine the discount rate in DCF valuation, discount rate cash flow. Yes. Calculate the book value of assets. No. Find the highest possible exit price. No. Ignore the effect of capital structure. So the answer is A. When valuing a privately held company, which of the following discount is most relevant? Marketability discount, volume discount, seasonal discount, bulk purchase discount. So privately held company, which discount is most relevant? So the answer should be A. As per ICA valuation standard, a valuation report must include a fixed valuation numbers without any assumption. No. Only a qualitative assessment. No. Disclosure of valuation methods, assumptions and limitations. Yes. So the answer is C. In which of the following cases is a forced transaction value most relevant? Most relevant. Forced transaction value. An acquisition where the buyer has a strong negotiating position, a distress sale under time constraint, voluntary merger between two companies. No. A real estate valuation under normal market condition. No. Forced transaction value most relevant. So the answer should be B, a distress sale under time constraint. As per Ind AS 2, inventory shall be measured at lower of cost or NRV. So the answer is C. Which of the following is not included? Not included. Which of the following cost not included in inventory? Cost of purchase, no. Storage cost, unless necessary in production, directly attributable, no. Fixed and variable overhead in production, which is not included in inventory. So the answer is B, storage cost, unless necessary. First in first out methods of inventory valuation assume that FIFO methods. The most recently purchased items are sold first. No, the oldest inventory items are sold first. Under Ind AS 32, which of the following is not classified as financial assets? Which is not? Cash and cash equivalent, investment in equity, trade receivables, goodwill. So the answer is D, goodwill. The market approach to investment valuation is most suitable when the asset has no active market comparables, the investment has a stable and predictable cash flow, market data on similar assets is readily available, the investment has significant intangible value. The market approach to investment valuation is most suitable when the market data on similar assets is readily available. So the answer should be C. Which of the following is not a key characteristics of fixed income instruments? Which of the following is not a key characteristics? Periodic interest payments, predefined maturity date, variables dividend payment, principal repayment at maturity, which is not a key characteristics. So the answer would be C. The valuation of bond using the discounted cash flow DCF methods primarily depends on The book value of the bonds, no. The interest rate set by the company, no. The present value of future cash flow. So the answer is C. Treasury bills are valued based on present value of expected future cash flow, fixed coupon payments over time, the face value payable at maturity, discounted for time value, the market capitalization of the issuing entity. Treasury bills, the answer should be face value payable at maturity, discounted for time value. So the answer should be C. The relief from royalty methods, RRM, for valuing intangible is based on estimating the royalty payment saved by the owning the assets, the historical cost of developing the intangible assets, no, the market price of comparable tangible assets, no, the total profit generated by the company, no. So the answer is A. Which of the following valuation method is commonly used for patents and trademark? Discounted cash flow, no. Multi-period excess earnings methods, yes. Replacement cost, no. Net asset value, no. So the answer is B. In the valuation of liabilities, which of the following is not considered? PV of future obligations, no. Expected credit risk, no. Market comparable of similar liabilities, no. Historical cost of liability. So which is not considered? Answer is D. Convertible bonds are valued using only the bond price of formula, only the equity valuation approach, a combination of bond and option pricing models, the book value methods. So convertible bonds are valued using a combination of bond and option of pricing models. So the answer should be C. The valuation of a hybrid instrument requires a simple interest rate model, a combination of debt and equity valuation techniques, yes. Ignoring market condition, no. Estimating the liquidation valuation only, no. So the answer is B. The key reason for periodic reassessment of inventory valuation is to reflect changes in production methods, no. To account for changes in NRV, yes. To comply with tax regulations, to increase the company's profit margins, no. Inventory. So the answer is B. When applying the with and without methods for valuing intangibles, the key principle is to compare financial performance with and without the intangible assets, use historical costs as benchmark, no. Apply a standard discount rate without adjustment, no. Estimate the market price of the asset directly, no. So the answer should be A. Compare financial performance with and without the intangible assets.